Let's dive a little deeper into the stock market. The term stock market refers to several exchanges in which shares of publicly held companies are bought and sold. The stock market is one of the more popular ways for Americans to invest because it has historically provided investors the opportunity to earn higher returns. However, there is always risk involved when it comes to investing in stocks, and nothing is guaranteed, including past performance. There are two basic ways to make money in the stock market. First, you can buy a stock and then sell it after it increases in value. The profit you make is referred to as a capital gain. Second, you can buy a stock that pays dividends to shareholders. Dividends are a company's earnings which it pays out to its owners or shareholders. Curious how a particular stock market is performing? That's where the stock market indexes come in. Stock market indexes track performance of companies whose shares are being bought and sold. Investors can use stock market indexes to decide which markets they want to invest in and how much of their money to put into each one. For example, one of the most used and followed is the S&P 500 index, which tracks the stock performance of 500 of the largest companies listed on the U.S. stock exchanges. Familiar big names like Apple, Microsoft, and Walmart. One way you can invest in companies that make up the S&P 500 is through an indexed fund. The goal of an index fund is to copy the holdings of whatever index it is tracking. Historically, indexes have had a pretty good track record for investors. The S&P 500 index has gained about 10.7% on average annually since it was introduced in 1957. However, keep in mind that stocks tend to fluctuate and come with risk for investors. In 2022, the S&P 500 index return on investment was actually negative 18.1%. Investing in stocks generally requires patience and time. To demonstrate, let's take a look at your potential rate of return with a hypothetical investment scenario. Okay, let's say you had $10,000 that you invested through the stock market over 5 years. Like we chatted through earlier, the S&P 500 index has historically returned an annual average of around 10.7%. But in this example, let's say your hypothetical investment had a return of 7% after 5 years. As a result, the money you invested would have increased by $4,025.52. This example shows how investing through the stock market could give you the potential to earn more with your money than just keeping it in a regular savings account. And if you keep your money in for 10 years, you are looking at a potentially greater rate of return because of the power of compounding.